Hello and welcome to Business Today Television. I'm Siddharth Zarabi, and with me today is Mr. TV Narendran, the Managing Director and Chief Executive Officer of Tata Steel. With the Q4 results out, Mr. Narendran, welcome to the show.
Thank you,
Uh,
Siddharth.
do, ex- do explain to our viewers your latest quarter. Uh, there's been a bit of a drag, but there's also been a rebound if you look at it on a quarter-on-quarter basis.
Yeah. So, Siddharth, if you compare it with the last year, same quarter, obviously they look like a drag because last year, this quarter was probably the highest ever profit in the history of Tata Steel. That was about a 9,000 crore profit quarter, so we won't be able to repeat that so easily. So, a fairer comparison is Q3 to Q4, where you've seen the rebound, largely driven by the performance in India. Few things have happened in the last few quarters. One is, in Q3, the Indian government removed the export duty on steel, which helped the Indian steel industry and Tata Steel. Secondly, in December, China decided to do away with the COVID restrictions, which also had a positive impact on the sentiment globally and on steel prices. So that's why you saw Q3, Q4, which was stronger than Q3. In Europe, things have got better, but not enough. Energy prices have come down, gas prices have come down. The winter is behind them, but operationally, we have a relining of the blast furnace going on. Hence, production is going to be lower this quarter as well. So Europe will see better numbers from Q2 and Q3, whereas India will continue to have a strong showing.
What segment has driven the demand in the quarter in India?
Well, auto has been very strong. If you look at commercial vehicles, passenger vehicles, they've been strong. Motorcycles have got better, but motorcycles are not yet at the levels that we saw in 2019. Motorcycles also get exported a lot. Export markets have been a bit weak. If you look at construction, infrastructure spend has been strong. Industrial structures, which is basically factories, warehouses, have also shown strong growth. Pre-engineered buildings, etc. A bit of a mixed bag in residential and commercial. Oil and gas has been strong. Railways has been strong. So across segments, we've seen strong growth. I think rural markets have been a bit weaker, which is also reflected in motorcycle sales. Wherever it's a discretionary expenditure, we've seen that the poorer sections of society have postponed discretionary expenditure because obviously household budgets have been hit by inflation and higher medical expenses over the last couple of years. So that's where the recovery is a bit more tentative, but infrastructure-led growth has been strong in India.
How is the current capacity utilization?
Oh, we are pretty much at 100% always. So we are always running full out. And the good thing is we are able to run full out and sell most of what we produce in the local markets. So, we are in a strong position there.
Overall, since you mentioned China as well, I want to ask you what has been the impact of the China opening for the sector and for your company also?
So, Siddharth, it started off very positively. I think sentiment was very strong in January once China opened up because huge amount of travel started in China. Also, it coincided with Chinese New Year. Visitors being allowed from overseas also created a huge bump up. So you were in Davos, you would have heard the commentary in Davos on China. It was very, very positive at that time. But I think what we've seen in March and April is that, some of that recovery, maybe, people were more excited than they need to be. So even if I look at the steel industry, production was pretty much at its highest in March in a long time. And because the demand didn't keep up with that production, exports was also higher than normal. It was about 8 million tons, which is 2 million tons higher than what it normally is. So I'm seeing a little bit of correction, recalibration, so to speak. I still think China will be reasonably strong this year. If China grows at 5% or 5.5%, I think that's incredible for an economy of that size. And that will have a huge impact. So I'm still positive about China, but not as overexcited as everyone was in January.
TV, what's the longer term Europe strategy? Europe, you continue to see losses at the EBITDA level. and we know what's happening there in the economy. What's your longer term strategy on Europe, and is there a trade off versus focusing more on India and expanding here?
So, Siddharth, the situation in Europe needs to be understood, in a slightly more detailed level, right? You have the Dutch assets, operations in Netherlands, which is 70% of a European footprint, is a pretty strong asset. It has always been cash positive, EBITDA positive, and does not require any support from India. So they can run on their own. Okay, so we are less concerned about that. We've had a couple of bad quarters. We will have one more bad quarter simply because there's a blast furnace relining which is going on there. Uh, in Q3, Q4, we were hit by higher energy costs, etc. So, but we are not, worried about the structural strength of the Dutch operation. It's a sustainable business. It can run on its own. It can transform. The challenge is UK, which is 30% of our footprint there. That's not cash positive. More often than not, it's cash negative. More often than not, it's EBITDA negative. And many of the facilities there, particularly in the upstream, are reaching the end of life. So the clock is ticking on that one. So that's a call we'll have to take during this year or latest by next year. During this year and next year, those assets will come to end of life. And if there is not enough support from the government, we cannot transition to a new process route. The cash flows from the business don't support investments, any more investments than we've made already there. So that's the challenge. To go back to your fundamental question, does this impact our growth in India? The answer is no, because like I said, the growth in India is taken care of by the cash flows in India, which are very strong. And like I said, if the Dutch assets don't need our support, and it's just the UK assets, which is 3 million out of 32 million, it's not as material as it was 10 years back when it was 10 million out of 25 million.
Uh, just some more clarity on what really is the issue with the UK government's support for the plant. You said end of life in terms of the asset. Uh, do they feel that there is not enough logic in continuing to support or an upgrade and a revamp? What's your sense about the thinking of the UK government?
So, Siddharth, the point is the existing assets make steel using blast furnaces and coal. Okay. Uh, so, our ask from the UK government is not to put money into the existing assets because we also know that in the long term, particularly in Europe, using coal to make steel is not a long term solution, right? So, what we propose to the UK government is UK has a lot of steel scrap and UK exports a lot of steel scrap, right? Many countries in the world, like China, has an export duty on scrap. Okay, so countries who have steel scrap try to recycle steel and make steel using scrap, which is a greener way of making steel. So our proposal to the UK government was let's co-invest in changing the process route, leveraging the scrap that is available in the UK to make greener steel because the carbon footprint when you make steel through recycling is much lower than the carbon footprint when you make steel using iron ore and coal. And hence, it fulfills the UK government's ambition to reduce the carbon footprint of UK as a country. It helps us build a sustainable business, relying more on locally available raw material than imported iron ore and coal, and makes greener steel. So, in many ways, it ticked a lot of boxes, and hence we thought that this was a proposal which should interest the government and support a business case.
And do you see them coming around to your logic?
Well, they understand the logic. I think where we differ is how much of support they can give us, because our ask is for at least 50% of the capex support that is required. What they've come back with is maybe about 20% of the capex support, which does not, help us. And what we're asking for is not different from what other companies are asking other governments. Germany's Salzgitter in Germany, Thyssen in Germany is asking the same of the German government, and I think they've already promised some support. ArcelorMittal is seeking and getting some support like that from the Spanish government or from the Canadian government. So what we're asking for is not unique. I think others in the industry have already asked it and have progressed in those discussions. And so we're seeking the same support and the same progress.
By when do you see clarity emerging? You did say over the next 12 to 24 months, if I heard you right. But is there a sort of internal deadline that you are working in calendar terms?
No, clearly we need to take a call in the next few months because, like I said, the assets will reach the end of life in the next 12 to 24 months. So we cannot if you waited till then, it's already too late. You know,
Oh,
so I think the sooner we take these calls, the better we can plan for the future.
okay. Let's turn to the debt reduction that you've done, and in previous interactions you've spoken about it. For our viewers, what's the latest situation as far as your debt reduction plans are concerned, and is there an outlook for the current financial year that you would like to share?
Yeah, I think we are committed to debt reduction. We reduced it by about 3,300 crores during the quarter. We are committed to reduce it by $1 billion next year, which was our original commitment of at least $1 billion a year of debt reduction. And we kept to that commitment. In fact, we did better than that commitment in all years except last year. Last year was different because one is we had to spend about 10, 12,000 crores on acquisition of Nilachal and Rohit ferroalloy plant. In addition, we had the situation in Europe, which obviously led to margin compression in Europe. We had a situation where there was export duty in India, which disrupted our plans for India. Also, coal prices were very volatile, went up from $250 to $650, and that has a huge impact on working capital because at the same level of supply chain efficiency, you're holding 2 to 3 times the amount in working capital because the value of what you're holding has doubled or tripled. So these were the challenges we had, and hence we could not reduce the debt last year. But we are back to what we are committed, and we are confident we can do that this year.
What's your outlook on margins? And as I can see the numbers, the India business has witnessed a margin improvement from 15% to 22% due to better realizations. What's the outlook for the current year?
Well, on an average, I mean, quarter on quarter, there'll be ups and downs depending on the geopolitical situation or what's happening in China or seasonal issues like monsoons, etc. But on an average, we expect FY24 to be better than FY23.
Okay. TV, as we wind down the conversation, I just want you to tell our viewers about what is likely to happen on steel prices. China production has dipped in the month of April. Do you expect any increases or stability in the near term?
Steel will always be volatile, but I think within a band, we've always felt that it will be volatile in the $500 to $700 band range. I think today we are, still in that range. In unusual circumstances that we saw last year when coal price goes to $500, $600, then steel price goes to $900. But otherwise, an long-term average of 600 is what we always see as a, kind of if coal price is at around $200 to $250. So everything depends on coal and input costs. Steel prices softened a bit in April globally, but I don't think it can stay at this level for long unless coal prices drop further. Because if you look at the Chinese steel companies at today's steel prices, they're not making money.
Okay. And do you expect coal prices to fall further?
Well, the problem with coal is it's metallurgical coal, that is, which is the coal that we use in steel plants. It's a very illiquid market, So if there's a weather event in Australia, you will see coal prices will go up by some $100. Some port is closed or there's a problem with the railways there. So that's a problem. India is already the biggest importer of coking coal in the world. So we have about 300-400 million tons of coking coal is traded in the world, and India is already buying 60 million of that. So we are very vulnerable to these coking coal prices. Just now, 200, 250 is the range it's in, but I think it will typically be volatile in the 250 to 350 range. That's where it looks like to me.
Okay, that would be some amount of uncertainty. Very final point, and this is a broader point. Last 2-3 years, we've seen extreme volatility in input prices for industry. The supply chain has been disrupted. Therefore, you have had output consequences also. From a very broader perspective, as an industry leader, do you see some sort of certainty coming in this year, or are we bound for a similar uncertain environment?
The volatility last year was more than what, at least in our industry, more than what I've ever seen in my 35 years in the industry, right? So I'd never seen within the same year coal prices move from 250 to 650 back to now again 250, right? Within a 12-month period, and that kind of volatility doesn't help anyone. It doesn't help steel industry, doesn't help our consuming industry. But I suspect this kind of volatility is not. There will always be volatility, but not at this level, right? So I think within $100 band, there will always be volatility, $100 to $200, and I think that is something we should learn to live with, and hence the need to look at supply chains in the context of volatility rather than supply chains in the context where there is no geopolitical issue or there is no volatility. So some amount of volatility we have to really plan for as industry, and how do we deal with that is to me one of the management challenges.
Absolutely, and I wish you well for that challenge, TV, because what you really are saying is that while change is constant, I think we can add that volatility is also a constant for
Absolutely.
managers like you. Thank you very much for your time with us today. With that, it's a wrap on this conversation. That was the Tata Steel CEO and MD talking to us about the latest results and the outlook for the industry. If you've been watching, thank you very much.
Thank you, Siddharth. Thanks.